Welcome to Tesla Daily News Podcast. I'm bringing you the Tesla stories that matter for investors on March 13th, 2026. Today, we're tracking a risk-off macro tape driven by oil back above $100, a major expansion move in Tesla energy in the UK, and fresh headlines around autonomy, safety, and competition in robotaxis. Story 1: Oil shock is back, and it's squeezing risk assets. Hook. Crude briefly jumped back over $100, and markets are treating this Middle East conflict like it's not ending soon. Context: for Tesla, higher oil is a mixed signal. Long term, it can help EV demand by making gas cars more expensive to run. Short term, it's usually bad for growth stocks because it reignites inflation fears, pressures consumer spending, and can push rate expectations higher. Details: multiple reports described escalating disruptions around the Strait of Hormuz, with the International Energy Agency warning the war is creating what it called the biggest ever disruption in oil markets. One estimate cited flows through the strait down more than 90% and about 7.5% of global crude supply disrupted. U.S. equity futures and major indices opened lower. In one market snapshot, Tesla was around $400 per share and down about 1.7% during the session, alongside declines across the mega-cap tech complex. Impact: investors should think about this as a valuation headwind. If oil stays elevated, the market may price fewer rate cuts, which tends to compress multiples on high-duration names like Tesla. It can also create near-term margin pressure across supply chains and shipping. Takeaway: watch oil, not just Tesla headlines. In this tape, macro can swamp single stock catalysts. Story 2: Tesla just got a green light to become an electricity supplier in Great Britain. Hook. Tesla Energy Ventures now has a license to supply electricity to households and businesses across England, Scotland, and Wales. Context: this is important because Tesla's energy business has been one of the clearest fundamental growth vectors outside vehicles. Becoming a licensed supplier opens the door to recurring revenue and grid services, and it strengthens the Powerwall and Megapack ecosystem. Details: Britain's regulator Ofgem approved the license after a multi-month review, with the license taking effect this week. Several outlets noted Tesla has been involved in the UK energy market since 2020, when it obtained a generation license. The coverage also highlighted Tesla already operates as an electricity supplier in Texas. Impact: strategically, this sets up a real competition dynamic with established players and potentially a showdown with Octopus Energy, which already has strong consumer adoption and software-driven tariffs. If Tesla can bundle Powerwall, solar, EV charging optimization, and virtual power plant participation, it can build sticky customer relationships and generate high-quality recurring cash flows. Takeaway: for Tesla valuation, this matters because software-like, recurring energy revenue can command higher multiples than pure auto manufacturing. The key thing investors should watch next is product packaging, what tariffs Tesla offers, how aggressively it prices, and whether it can scale customer acquisition without heavy marketing spend. Story 3: UK energy entry also brings political and regulatory heat. Hook. The license is approved, but backlash and scrutiny are loud, and that raises headline risk. Context: investor perception and regulatory risk affect Tesla's execution speed, especially in tightly regulated markets like energy. Details: reporting in the UK described objections linked to Elon Musk's political activity, with critics urging government intervention. Ofgem emphasized consumer protection obligations, financial responsibility, operational capability, and fair treatment rules, and noted it licenses companies, not individuals. Impact: even if Tesla executes well operationally, political pushback can slow partnerships, complicate customer acquisition, and raise compliance costs. For the stock, that's not an immediate earnings line item, but it can shape the market's confidence in international energy expansion. Takeaway: treat this like a real business launch with real regulatory oversight. The upside is meaningful, but the path won't be frictionless. Story 4: autonomy safety headlines are back in the spotlight. Hook. A viral video claims a Tesla on full self-driving drove into a railroad crossing barrier. Context: Tesla's autonomy narrative is one of the company's biggest long-term valuation pillars. That makes safety perception and regulatory investigations extremely stock-sensitive. Details: the video circulating on social media appears to show the car approaching a rail crossing as the barriers come down, continuing forward, then braking late and accelerating off the tracks. Some reports note the post was later removed, and key details like software version and hardware generation were not verified. The coverage also pointed out that full self-driving is still considered a Level 2 driver assistance system, meaning the driver is responsible and must supervise at all times. Impact: these episodes amplify regulatory risk and can pressure adoption of paid autonomy subscriptions. They also reinforce the core investor question: can Tesla scale FSD to broader deployment without a spike in publicized incidents? Takeaway: for investors, track the signal, not the noise. Regulatory actions, recall activity, disengagement rates where available, and whether Tesla provides clearer transparency in reporting. Story 5. New legal risk. Cybertruck Autopilot crash lawsuit targets governance and sensor strategy. Hook. A new lawsuit alleges autopilot malfunction in a Cybertruck crash and claims Tesla was negligent in keeping Musk as chief executive. Context: litigation can be a direct cost, but more importantly, it can drive disclosures, discovery, and regulatory attention. Details: the complaint describes a crash on a Houston overpass where the vehicle allegedly failed to follow a curve and struck a barrier, with the driver claiming she attempted to disable the system. The lawsuit argues Tesla overstated autopilot capabilities and criticizes the choice to rely on cameras rather than adding LiDAR redundancies. Impact: this ties into the broader autonomy debate, Tesla's camera-first approach versus multi-sensor stacks. Even if Tesla wins cases, repeated headlines can raise perceived risk and potentially slow rollout or increase compliance burdens. Takeaway: the market will watch whether lawsuits cluster and whether they coincide with new regulator actions. That's where sentiment can shift quickly. Story 6. The robotaxi competitive landscape is heating up, and it matters for Tesla's autonomy premium. Hook. Lucid unveiled a steering wheel-free robotaxi concept and launched self-driving subscriptions, while Uber expands its robotaxi platform partnerships. Context: Tesla's long-term bull case often hinges on robotaxi scale and software revenue. Competition isn't just other car makers, it's platforms, regulators, and ecosystems. Details: multiple reports said Lucid showcased a two-seater robotaxi concept without pedals or a steering wheel and outlined autonomy subscriptions priced roughly from $69 to $199 per month, depending on capability. Separately, Uber announced plans to add Amazon's Zoox robotaxis to its platform, expanding from Las Vegas to Los Angeles next year, and has also discussed autonomous offerings with other partners. Impact: none of this dethrones Tesla on its own, but it reduces the chance Tesla will be the only credible consumer autonomy brand. If more companies normalize subscriptions and robotaxi concepts, the market could demand clearer proof of Tesla's unit economics and safety performance before awarding a bigger autonomy multiple. Takeaway: investors should watch for concrete milestones, regulatory approvals, real paid ride volumes, cost per mile, and utilization. Concept cars and subscription price lists are easy. Scaling is hard. Story 7. Tesla demand and brand signals in Europe stay mixed. Hook. One report noted Germany registrations down sharply and market share pressure, while Tesla's German Gigafactory financials showed softer profitability. Context: Tesla's near-term earnings power still depends heavily on automotive margins and volume. Regional softness, especially in Europe, matters. Details: reporting cited Tesla registrations in Germany down about 48% recently, with market share around 0.7%. It also referenced Gigafactory revenue in 2020 for around 7.7 billion euros and operating profit around 156.8 million euros, with 2025 figures not yet available. Impact: this keeps attention on pricing, incentives, and mix. If Europe demand remains weak, Tesla may need to lean on cost reductions or new product catalysts to stabilize margins. Takeaway: watch for any pricing moves, refreshed models, or cost-down progress that changes the margin story, because that's what will feed into near-term estimates. That's the rundown for March 13th, 2026. The big themes today are macro risk from oil, Tesla Energy's meaningful step into UK retail electricity, and renewed autonomy headline risk amid rising robotaxi competition. For tomorrow, keep an eye on oil and rates first, and then watch for any follow-up from regulators on FSD and any details on Tesla's UK energy product rollout, pricing, partners, and whether Tesla starts pushing a clear Powerwall and virtual power plan offer. If you found this useful, subscribe to Tesla Daily News Podcast, follow for daily updates, and check our site for links and episode notes. Talk tomorrow.